Start of the year has already rocked Canadian oil stocks and rallied precious metals until today. It's only week 2. Let's talk about the year ahead with Martin Cobb, Senior Vice President, Equities at Lorne Steinberg Wealth Management. Martin, thanks for joining us. Happy New Year. Good to see you.
Happy New Year to you, Marella. Good to see you too.
So there will always be curveballs. We know that, especially when you have the kind of administration you have in the U.S. But how are you positioning to start off this year?
Cautiously optimistic, in the sense that, I have no idea where the market might head. But I saw David Rosenberg writing about diversification being a dirty 15-letter word. I thought that was absolutely spot on. I think this may be a year where being diversified is more important than it has been, let's face it, the last 2 or 3 years, where there's only been really one trade in town. So I would say, we can still find businesses in this part of the world and other parts of the world that are great businesses on attractive valuations, but you have to be a little bit more selective. I do think just owning an ETF today of the S&P 500 or even the TSX is very concentrated in terms of the types of companies you own and therefore the risks that you're exposed to.
Okay, so obviously we have been very focused for the last year or more on tech stocks with the AI drive. Many of them I know you see and others see as overvalued. Are there other sectors besides tech where you see that same trend of things being overvalued and maybe we need to sort of move away from?
Yeah, I think in terms of overvaluation within the tech sector, we've talked before, Morel, about this, particularly in the private space. The valuations in the funding rounds that you have for the likes of OpenAI, Anthropic, suggesting valuations in the hundreds of billions of dollars, with revenues, in the tens of billions of dollars and profits in the negative. Whereas, someone like, Alphabet, or Microsoft, Amazon, there are still some risks there, but they're much better positioned businesses. But yes, if you look around the world, or even just look in Canada, look how well the banks did last year. We like the Canadian banks over the longer term, but you've seen, I think the worst performing Canadian bank last year was up around about 30%. So a lot of that is just a valuation expansion. So again, it comes back to my earlier point. Still like these businesses in the long term, but just be mindful of position sizes, mindful of the prices you're paying for a number of these areas. Banks would be one, but there's some other sectors or some stocks that just the market seems to have fallen in love with.
Okay, are there certain sectors that you are staying away from? Consumer spending is some I've heard are staying away from that. They just don't feel necessarily that because of the uncertainty and the economic outlook that consumers are going to continue to spend.
It depends on what you're paying. That you've heard me say it before. I tend to zig when others zag and vice versa. And if valuations are discounting a lot of uncertainty and a lot of fear, that can be happy hunting ground for me as a kind of classic value investor trying to buy the world's best businesses on sale. So no, I wouldn't shy away from that sector. If valuations, are discounting a worst case type scenario, that can be a great opportunity for those with a longer term view. But I look at some stocks, and stick with Canada again, Aritzia here or Dollarama. I know Brian Belsky was talking about them just earlier in the show. I take the opposite view. I struggle with the valuations on those types of stocks to some extent, looking probably to line up a little bit. We still like Dollarama, but the valuation is now discounting a continuation of the very strong growth levels, which, they may soften somewhat.
Okay, so let's zero in on a couple of stocks you do like right now. Compass is one of them. They're a catering group worldwide, I believe. Tell me a bit more about what piqued your interest here.
Firstly, I love finding world-leading businesses that may have the bulk of their business in the US, but they're not US domiciled and therefore traded at a discount. I think Compass fits that bill extremely well. We've never heard of it, but we've almost certainly used its services. They are the world's largest contract catering company. So if you go to a sports stadium, you go to a university, mess hall, you go to, offshore defense platform, there's a chance that Compass or Sodexo or Aramark will be serving you that product. They say they're the world's largest, and it's a great long-term growth industry. A lot of mom and pop type businesses, but also a lot of the industry is still in-house. Companies still doing it themselves, and they can save money by outsourcing to the likes of Compass. The reason I got really interested is they did a rights issue, a capital raising during the pandemic, bolstered the balance sheet, because let's face it, half their business disappeared. No one was going to sports stadia, educational establishments, etc. We got a chance to pick up the business with a very strong balance sheet, with it strong enough to get it through the pandemic. Very fortuitously, just bought it before Pfizer Friday. but it's a great long-term story that's still attractively valued, 20 times multiple for low double-digit earnings per share growth and a market leader, as I said.
Okay, let's get to another pick of yours, which is Starbucks, which has been going sort of sideways. I know they have a new CEO who's trying to turn things around. They haven't seemed to get much traction so far, even though they sort of laid off managers and have sort of tried to go back to what they used to be, the hangout place, the coffee house. But what do you like about Starbucks moving forward? Do you see sort of a return to what they used to be?
You've hit the nail on the head there, Morel. I mean, back to what Starbucks used to be. I mean, indeed, that's their slogan, back to Starbucks. And, as a customer, and you've certainly seen it in their numbers, we have all felt a little bit alienated with the massive queues, the complexity of the menu. I just have Grande Black dark roast. So I'm the one trying to get my easy coffee, and someone in front of me is getting everything, using my daughter, to be honest. So I do think there's a lot of self-help here. It's not going to be a quick fix. Yes, the stock has gone sideways. The business is now starting to go sideways. That's actually a good thing because you've seen, obviously, real poor numbers in terms of visitors, same-store sales in the US. Now evidence that's stabilizing. They seem to be doing something in China. That business was a great growth engine for them, has stalled, and they're now extricating themselves to some extent. But very simply, if they get back to Starbucks, get back to the sort of margins, mid-teens operating margins they've historically enjoyed, they throw off something like $5 earnings per share. It will take several years, but with an $80 plus share price, that's a very attractive price to pay for Starbucks today.
Do you think customers want to go back to Starbucks? As a Starbucks consumer in the past, do you think customers want to return and pay that $7 for a cup of coffee these days?
It may not be the $7. They have to be price competitive. And we are in an environment, absolutely, hitting it on the head in terms of affordability issues, whether it be here in Canada. You've seen how well Dollarama's done as a business. All the chatter about affordability in the US, and it's obviously preying on the administration's mind. So the $7 coffee, I've never paid $7 for a coffee. I never intend to pay $7 for a coffee. That part of the business, may struggle to some extent. But if they can get back to that community, third place as they called it, offering competitive products quickly and efficiently, I believe there's a lot of upside in Starbucks from here.
I believe you probably paid a $7 Frappuccino magic thing for your daughter if you haven't paid for a $7 coffee yourself. They love those things with the whipped cream on top. All right, Martin, thanks for joining us. Appreciate it.